You indicate, that the research really focuses in on a total return investment strategy, and all the research is based on that assumption. Mm-hmm. But everybody doesn't invest that way, so I would imagine that has an impact on the return, on the withdrawal rate as well, right?
Mm-hmm. Yeah, that could have an impact, and I think there's still disagreement on what the impact is, whether that would support higher or lower withdrawal rates. But another popular form of income planning in retirement is a bucket approach, where
right.
you build a bond ladder or have other dedicated assets for your short-term and medium-term expenses, and then leave stocks to hopefully grow untouched for at least a 5 or 10 year period. And historically, that kind of situation has tended to work, because when you build this short and medium-term bond ladder, you don't have to use as many assets. You can have a higher overall stock allocation. And so historically, that's benefited people when you look back at these rolling periods from historical data. There's disagreement on whether that's something you could really expect to continue in the future. So it's unclear still whether having this time segmentation is the name of this general category of
right. Yeah, and my experience is when you start talking about the bucket approach to mm-hmm. retirement income planning, that everybody means something different. I mm-hmm. mean, there's a lot of different things that are described as, mm-hmm. as buckets. But what they have in common is that this is not a total return strategy. It's a different strategy, and there's not much research on it at all. Mm-hmm. You're saying we're starting to see a little bit of research. The word's still out whether it helps or hurts, but I think your first point was that if, at least historically, if you use this approach and it allowed you to have a higher allocation in equities, then you can have a higher withdrawal rate, right? Or it supports a higher withdrawal rate or greater success, I guess.
Or yeah, it's more like you have more wealth left over at the end of the period. Mm-hmm.
Okay, if you use the traditional approach.
Yeah, I don't think anyone really tested about whether it supports a higher withdrawal rate, although it naturally does. If you have more wealth left over, that means you could have spent more.
Okay.
As long as you didn't hit zero somewhere in the middle.
All right.
It's not completely, it doesn't completely follow that higher ending wealth would support a higher withdrawal rate if it's more volatile, because once you hit zero, it's game over.
Yeah, and I think that's a really interesting area where we're going to see more research. We need more research in these various types of income investment strategies that people are using to determine whether they really make sense or they're working. Mm-hmm. Do they really add value?
If I might just add about that as well, a lot of the value may just be on the behavioral side. Mm-hmm. Again, that we talked about earlier, that it's assuming people with a total returns perspective, they keep that asset allocation that they said they were going to, that the research assumes. But if people do panic and sell their stocks, if time segmentation, by having, Harold Avinsky talks about a 5-year mantra, where if people know that the next 5 years are going to be covered by fixed income, they may not panic and sell their stocks. And so if, in real terms, it causes somebody to maintain a more effective asset allocation strategy, then outside of what the general research, assuming the perfectly rational person is doing, it may have a real-world impact and be helpful in that way.
Right, if it can help people feel comfortable with their equity position and sleep better at night and actually not sell those equities when they go down, that's very helpful.
Yeah, then that could be helpful, because the proper comparison is not to somebody who always maintains the perfectly fixed asset allocation, but to somebody who would make mistakes and panic. Mm-hmm. And then it can be a winner in that regard.
This one we actually hit a little bit, but the 9th point you made was that what the impact of a client who's willing to change their spending based on the actual returns. Let's go over that one again. So I think that was an important point.
Yeah, so there could be more issues to talk about here as well. There's the issue of the flexibility, where if somebody is willing to reduce their expenses if they get bad luck string of returns with their investments, then they can start with a higher withdrawal rate. Or if people are naturally just going to reduce their discretionary spending with age, they can use a higher withdrawal rate. Then there's also this real-world issue of the Social Security claiming decision, where if somebody waits till they're 70 to begin Social Security, then you get into all these complicated patterns. They can go ahead and spend more for through age 70 with the idea that once they reach age 70, they're going to have a much higher Social Security benefit, and then may not need to spend very much from their portfolio.
So, right, we may not have consistent spending from the portfolio
mm-hmm.
over retirement based on other types of strategies like
mm-hmm.
the one you're just describing. Yeah.
Mm-hmm. So that all adds complications, and that's why 4% is not helpful for somebody who's specifically going to think about delaying Social Security, because it may be better to wait till age 70 than to start Social Security at 62 and use 4% the whole time.
Right, and I think we've seen, I mean, I've seen some research from primarily Reichenstein that's
mm-hmm.
talked about, you know, that you can do better, you know, your portfolio will actually last longer if you spend it down a little bit more early on,
mm-hmm.
and then you don't have to take out as much because of the higher Social Security benefits later.
Yeah, exactly.